Greetings, viewers. I'm your guide through the world of smart investments and tax strategies. Today, we're going to unlock the secrets of tax optimization for investors. It's a big world out there filled with opportunities to keep more of your hard-earned money in your pocket. We'll be exploring key points like understanding tax implications, tax loss harvesting, and the benefits of tax-advantaged accounts, among others. So buckle up as we dive into the world of tax hacks for investors. Investments can significantly impact your taxes, and understanding this is the first step towards smart tax planning. So, how do investments influence your taxes? Well, profits from your investments, known as capital gains, can be taxed differently depending on whether they're short-term or long-term. Short-term capital gains come from assets owned for less than a year and are taxed at your ordinary income tax rate. Long-term capital gains from assets owned for more than a year usually enjoy lower tax rates, but here's the catch. To take advantage of these tax rates, you need to keep accurate records of your investments. This includes when you bought the asset, how much you paid for it, and when and how much you sold it for. Without these records, you may miss out on tax-saving opportunities. Remember, knowledge is power when it comes to tax planning. Our first tax hack is a strategy known as tax loss harvesting. Now, what is tax loss harvesting? It's an approach that investors use to minimize their income tax liability. Here's how it works. When an investment in your portfolio experiences a loss, you can sell that investment to realize or harvest the loss. This loss can then be used to offset capital gains from other investments, effectively reducing your tax liability. Let's illustrate this with an example. Imagine you own two stocks, Stock A and Stock B. Stock A has gained value over the year, while Stock B has lost value. By selling Stock B, you can offset the gains from Stock A, thereby reducing your taxable income. But remember, while this strategy can be beneficial, it's not without its rules and limitations. The Internal Revenue Service, or IRS, has a rule known as the wash sale rule. According to this rule, you cannot claim a loss on a sale if you buy a substantially identical stock or security within 30 days before or after the sale. This rule is designed to prevent investors from selling securities just to claim a tax loss, only to buy them back immediately. Moreover, the amount of capital losses that you can use to offset your income in any given year is also limited. If your capital losses exceed your capital gains, the excess can be used to offset up to $3,000 of other income. If your total net loss is more than the yearly limit, you can carry the unused part forward to future years until it's all used up. It's also worth noting that tax loss harvesting is more effective for investments held in taxable accounts, as opposed to tax-advantaged accounts like 401(k)s or IRAs, where capital gains and losses don't immediately impact your tax situation. Tax loss harvesting can be a game changer if used wisely. It's a powerful tool in your tax optimization toolbox, allowing you to manage your investments in a way that can help reduce your tax bill. But like any tool, it's most effective when used appropriately and within the bounds of the law. Next up, we have tax-advantaged accounts such as 401(k)s, IRAs, and HSAs. These are special types of investment accounts that come with tax benefits to incentivize saving for specific financial goals like retirement or healthcare expenses. Let's start with 401(k)s. These retirement accounts are typically offered by employers, and they allow you to contribute pre-tax dollars directly from your paycheck. This reduces your taxable income for the year, and the investments in the account grow tax-free until retirement. However, keep in mind there are limits to how much you can contribute each year. For 2024, the maximum contribution for those under 50 years old is $19,500. Next, we have individual retirement accounts, or IRAs. Similar to a 401(k), these accounts offer tax-free growth. There are two types: traditional IRAs, where contributions may be tax-deductible, and Roth IRAs, where withdrawals in retirement are tax-free. The contribution limit in 2024 for both types is $6,000 or $7,000 if you're 50 or older. Lastly, we have health savings accounts, or HSAs. These accounts are designed for individuals with high-deductible health plans. They allow you to contribute pre-tax dollars to pay for eligible healthcare expenses. The contributions are tax-deductible, the growth is tax-free, and withdrawals for eligible expenses are also tax-free. For 2024, The contribution limits are $3,650 for individuals and $7,300 for families. Each of these accounts has specific rules for when you can withdraw your money. For most 401(k)s and traditional IRAs, you'll face a penalty if you withdraw before age 59 and a half. For Roth IRAs, you can withdraw your contributions at any time, but earnings may be subject to penalties if withdrawn early. And for HSAs, you can withdraw for eligible healthcare expenses at any time. Investing in tax-advantaged accounts can be a significant step towards tax optimization. By understanding how these accounts work, you can strategically reduce your taxable income and let your investments grow more efficiently. Donating appreciated securities is another smart tax hack that investors can use. When we talk about appreciated securities, we're referring to investments that have increased in value since they were purchased. Now, if you were to sell these securities, you'd be liable for capital gains tax on the appreciation. But if you donate these securities instead of selling them, you can sidestep this tax entirely. This is where the tax hack comes into play. By donating appreciated securities directly to a qualified nonprofit organization, you can potentially take a tax deduction for the full fair market value of the securities. That's right, you heard it correctly, the full fair market value. This is typically more than what you initially paid for them. Now you might be thinking, why not just donate cash? Well, donating securities over cash has its advantages. Not only do you get to avoid capital gains tax, but the nonprofit organization can also sell the securities without incurring any tax. It's a win-win situation. However, to claim this deduction, you need to have held the securities for more than 1 year. Also, remember to get a written acknowledgement from the nonprofit organization for your donation. This documentation is crucial when it comes to filing your tax return. In conclusion, strategically donating appreciated securities can yield substantial tax benefits. So why not make your charitable donations work harder for both you and the causes you care about? Our final tax hack involves smart asset location. Just like how a real estate investment's worth is influenced by location, the same applies to your investments. This is the concept of asset location. Asset location is about strategically placing your investments in the right types of accounts to maximize your after-tax returns. It's not just about what you invest in, but also where you hold those investments. To illustrate, consider tax-efficient investments. These are investments that generate little to no taxable income, such as index funds or ETFs. These investments are best held in taxable accounts. Why? Because their tax efficiency means you won't be hit with a hefty tax bill, allowing your investments to grow largely undisturbed. On the other hand, tax-inefficient investments generate a lot of taxable income. Think high-turnover mutual funds or bonds. These are best held in tax-advantaged accounts, like your 401(k) or IRA. The reason? The income they generate is sheltered from taxes, allowing you to keep more of your returns. So the key takeaway here is to consider not just what you invest in, but also where you hold those investments. By doing so, you'll be better positioned to optimize your returns and keep more of your hard-earned money. Remember, not just what you invest in, but where you hold those investments can significantly impact your after-tax returns. Lastly, our bonus tip for you. Always stay informed and don't hesitate to seek professional advice. The world of tax laws and regulations is constantly evolving. Staying abreast of these changes is crucial to maximize your investment returns. Make it a habit to regularly check trusted financial news sources and official tax websites. But remember, the internet can only take you so far. Tax matters can be complex, and each investor's situation is unique. This is where professional advice comes in. A qualified tax professional or financial advisor can provide personalized guidance tailored to your specific needs. They can help you navigate the intricate web of tax laws, identify potential tax-saving opportunities, and avoid costly mistakes. Furthermore, there are numerous resources available to learn more about tax optimization strategies. Books, online courses, podcasts, the options are endless. Arming yourself with knowledge and getting the right advice can make all the difference in your investment journey. Well, that wraps up our discussion on smart tax hacks for investors. We've navigated the world of tax loss harvesting, explored tax-advantaged accounts, considered the benefits of donating appreciated securities, and examined the importance of holding investments in the right accounts. Remember, staying informed and seeking professional advice can make a world of difference in your investment journey. So, go ahead and implement these strategies to optimize your returns. Thank you for joining us today. Don't forget to like, share, and subscribe to stay tuned for more insightful videos.